Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. I'm absolutely thrilled to have with us Calvin Liu. He is the Chief Strategy Officer at EigenLayer, which is a restaking platform, and we'll talk about what that means. He was also very early to participating in DeFi, was the strategy lead at Compound, and an entrepreneur before that, as well as, I think, touching the dark arts in the investment banking world. So we'll open up how all of these things connect and probably learn a lot. Calvin, welcome to the conversation.
Hey, thanks for having me. Great to be here.
Absolutely. So let's start with your foundational experiences. What did you do your undergrad in? And then how did you get pulled into the black hole of investment banking?
I graduated in 2009 from college. I studied economics and philosophy. When I went to college, I wanted to study psychology and philosophy. I thought of psychology as sort of understanding how people work, and philosophy as thinking about how kind of people and societies should work or should aspire to work. After a couple of years, I decided to switch psychology to economics. And so I described philosophy as sort of how people in society should work. And I thought of economics as like the philosophy of money. Like if you assumed that people should sort of operate by maximizing for economic outcomes, then how would the world work? So it was like a philosophy of money to me. So those are the two things that I majored in. And I graduated in 2009, like I mentioned, which was sort of in the middle of a financial crisis. Quite frankly, I didn't know exactly what I wanted to do, but investment banking was the thing that sort of a lot of people were aspiring to do, especially I went to college in New York. So I wanted to be in finance. And really it was more like I didn't really know what it was about, but it was like a high achieving thing to do. So that's how I ended up there initially.
I was going to ask you if you picked up utilitarianism from your study of philosophy or your study of economics as the philosophy of money. Like, I guess the also tongue-in-cheek question to ask would be, are you an effective altruist? But maybe we'll leave that behind.
No, I'm not. Although I was pretty interested in it a long time ago, probably close to 10 or 10 plus years ago. And I remember I went to an effective altruism conference that was at Google, the Google campus in Mountain View. And Elon Musk was the speaker. Brought his whole family at the time. And yeah, I think he was also much less famous at the time. It was pretty interesting. But this was like a decade ago. Yeah, I didn't really vibe with it, quite frankly, entirely, but I was interested in it.
The other question of the philosophy of money, like, I mean, for some people, economics is just math or a model of reality, very simplified and sometimes incorrect model of reality. What made you think that economics encompassed or integrated philosophy in any way? Like, what values does economics include for you?
Yeah, I think it is, and this extends all the way till now to kind of my interest in crypto. It's about incentive design. So especially microeconomics, microeconomics and macroeconomics, I think a lot of it is about if you want the system to work in a certain way, what are the different ways that you can create incentives for people to that sort of push the system in certain directions? That was my interest in it. So not exactly like the econometrics or the math part, but really about incentive design. My favorite class in college was actually in the law school. It was called Economics and the Law. And it was about how you would create laws or how laws were decided with an economic frame. So for example, like if you wanted certain behavior to occur or not occur, what are the economic incentives that you can introduce into the system to reach like different equilibria, basically?
I'm guilty of pursuing economics and the law as a rabbit hole, probably in a way that's become very expensive to me over time. So you got pulled into banking in part because of it was the thing to do. Were there good things that you picked up out of that experience? What were the fundamentals you got there?
In terms of career skills, what I learned was, quite frankly, how to work like brutally hard. Previously, through all of my kind of schooling and study, I had this mindset that I think I was kind of trained into. That was, you work hard and you study hard and you learn, but the outcome you're looking for is one that benefits yourself. Like you want to get a good degree so you can get a good job, and you want to learn these things to improve yourself. And having a job, like a real job, was the first time I realized, oh, okay, there's things I can do that impact other people in my work. And that really opened up. I mean, that changed, I think, me as a person in a lot of ways, where I was like, oh, okay, out in like the work world, the things that I do have an impact that goes beyond just like my little life. So there's where I began to think about like, okay, what's the impact that I can have in the world through my work instead of just, sitting in my room studying or writing papers back in school. So I learned how to work really hard. I learned how to storytell through presentations and decks. I learned, I think, how to be like really professional in a lot of different scenarios. The thing that I really carry with me today from kind of a values perspective is what kind of work do I want to do? So, I only did investment banking for a couple of years, but I realized pretty early on that it wasn't kind of the career path that I wanted to go down in terms of what I wanted to optimize for in my career, like what I wanted to learn, what's the type of impact that I wanted to have. I was working on technology mergers and acquisitions. And to me, it was like a fairly repetitive process. Investment makers get paid a lot of money because they know how to run this very complex process that nobody else knows how to run, and they just run it over and over again. And that type of repetition, I think, became something that I try to avoid the rest of my career, where I'm just in search of interesting experiences.
So how did you move on to entrepreneurship from there?
Yeah, so actually out of investment banking, my next job was with a financial regulations consulting firm here in San Francisco. And I was hired to work on this huge project. This was in, I think, 2011, 2012, where the US government, different agencies of the US government, like the DOJ and the OCC, the Banking Regulation Agency, had ordered the 14 largest banks in the US to go back and analyze every foreclosure that they'd conducted over the past 3 or 4 or 5 years. I can't remember exactly now. And basically make whole anyone that had been foreclosed on incorrectly. So the firm that I worked for was, I think, hired by 3 of these banks, huge banks, like the multinational global banks, to do audits of all these foreclosures. I think probably millions and millions of foreclosures. And so I was hired to work on this project and help like design the process and execute the process to actually conduct these audits, find out who had been harmed by them, and then get the banks to write checks to these people and sort of pay them back for anything that had been done incorrectly. And this was coming out of the housing crisis. And I remember actually like my interview at this financial consulting firm. It becomes really relevant to my career today because we were on the 41st floor of a building overlooking the bay in downtown San Francisco. And on the 42nd floor was Fortress Investment Group, which is where Dan Morehead and Pantera, the crypto fund, came out of. So we would ride up the elevator, and at the last 2 floors, it was just us and these Fortress guys once in a while, and we would just talk about Bitcoin in the very early days, like 2012, 2013. Meanwhile, I was working on like this project that came out of essentially failures of sort of Wall Street and the large banks over the past several years. And at the beginning of my time there, it overlooked like an Occupy Wall Street encampment on the Embarcadero in San Francisco. So yeah, it's just it was an interesting time. There we were like talking about Bitcoin, overlooking this Occupy Wall Street encampment, working on this huge project that came out of the failures of sort of traditional banks. And, that's really what shaped like a lot of things to come. So I was really, really, really interested in Bitcoin at first, sort of idealistically, like from a values perspective, what was interesting about it. And then actually, like, I was young and sort of, I think even back then, I probably couldn't have accurately described proof of work to you or to anybody. So I was paying attention to crypto, but not super invested in it either from a time or a financial perspective. So after Promontory, I was still really inspired by a mission to have a positive impact in the world, basically, kind of young and bright eyed. And that's how I got into entrepreneurship. And I became really, really focused on like developing the skills necessary to sort of create things and start things. Especially I was like really deep in the tech scene here in San Francisco.
I love that mental image of looking out over Occupy Wall Street from a skyscraper. It must have been quite powerful.
Yeah, it was really interesting. I remember in my interview at that firm, one of the partners interviewing me sort of stepped to the window and looked down at the encampment and asked me, well, what do you think about them and what they're trying to accomplish? Yeah, I'll never forget that image.
I have a similar image of the weekend that the Lehman Brothers bankruptcy happened and staring out of Midtown Manhattan as people were, cleaning out their desks and their boxes and leaving the firm. It's a weird thing because it's like, it's not a tragedy. I mean, it's sad and it's very destructive, but it's like the systemic failure and the answers come from systemic improvement. But it's very hard to see when you're just on the ground in that moment. What did you do with that desire to fix the world and do it through technology? How did that manifest?
So immediately after leaving that consulting firm, what I worked on was actually in a mobile app where you could write anonymous messages to people in your phone book and about people in your phone book. It would create like a profile page for them. But there were a bunch of questions and prompts around what you could write that would sort of push you to write positive things and compliments. And this is what I worked on for a little bit over it.
It sounds like you were really stressed out before you started this company.
There was a lot of the app's secret had blown up quite recently. And what it was, you could write anonymous comments about anybody, but there was no structure to it. So it devolved really quickly into negative comments. And so it caught a lot of flack. And I was like, well, can we make it so you can write positive comments? Actually, more recently, there was like a Gen Z targeted app. I forget what it's called. I think it was called Gas. That was the very similar concept, and it blew up. And I think it sold to one of the large social media companies. I can't remember which one. So I think I think it was an interesting idea. But what was really interesting about the experience, I had no idea what I was doing. I had never like made anything, started a company. The reason I gave up on it is because I was talking to a bunch of venture capitalists about it because it did have some usage and a lot of good feedback. And they were like, well, what's the business model? And I said, I don't know. And I basically put it away. I shelved it. But what it did was introduce me to a world of entrepreneurs who also had this idea of like, can I create something that I think is a positive contribution to the world? And meeting that type of person and knowing that that type of person existed in large numbers was really inspiring, basically, and gave me a lot of energy for the rest of my career.
You found your tribe, it sounds like. Can you chart the path to Compound and to, it sounds like the initial ideas of participating in crypto started coming out with Bitcoin and sort of Fortress and all that. But how did you take the risk, or at least how did you explore far enough to say DeFi is a thing, and like during a bear market in crypto, the new crypto thing is where I want to be?
So yeah, in the meantime, I worked for startups, became like a data product manager for a couple startups here in the Bay Area. And through 2015, 16, I was paying attention to crypto because I still had a little bit. And that's when Ethereum started, of course, had launched and people were starting to get interested in it. But it wasn't until late 2016, late 2017 that I noticed actually the beginnings of all the ICO activity that made me start paying attention again. So early 2017, I started paying a lot of attention to crypto. I essentially was, not spending all my free time in crypto, trying to understand what was going on, what were the projects that were launching, and kind of networking in the space. And through mutual investor friends, I met Rob Leshner, the CEO of Compound, in late 2017. And I started at Compound in early 2018. Why was I remember at the time, I was like, I have to work in this industry. I think there was a little bit of a refresher for me of those ideals and values that I'd originally seen in Bitcoin that I saw again in the Ethereum community. And I think that really compelled me. And then from a career development perspective, I was basically working on data analytics for a great company here in the Bay Area. But I always thought of things in terms of expected value. And especially early in my career, I wanted to basically maximize volatility and like the potential outcomes of my career. Kind of like an option price or something. What you want is like the most volatility, and that makes the option valuable. So I was really interested in crypto, and I basically believed that it would have a really volatile outcome. Either it would go to zero or be much, much more than it currently was at the time. And that's like the pretty basic rudimentary logic that I took to decide that I really wanted to work in the space. When I met Rob Leshner, though, what really struck me, and the reason I really wanted to be a part of Compound, where I was the second employee after two co-founders, it was Rob Leshner and the CTO, Jeff Hayes, their third company together, I think. And what I was struck by was not primarily the idea itself, but actually the way in which they approached building a company. So it was general startup building stuff where I thought, oh, they know what they have to do from a company building perspective. And that's what I want to learn. And that's why I think they could be successful.
That's amazing. I mean, being the third person at Compound does require applying some judgment about what's meaningful out in the world. How was Compound framed at that time? Like, what is it that they were trying to do? And what was the evolution and the ride over the next couple of years? Obviously, it's one of the most important protocols in DeFi today and a huge beneficiary of DeFi summer and sort of the mainstreaming of the sector. But what was that initial genesis, and what was the experience like being there?
The initial idea, as I first saw it back in late 2017, was actually to build a crypto bank. So the idea was, can we build a bank on Ethereum? And pretty quickly drilling into the idea, what the team, really the founders, realized is what's the most basic functionality that underlies a bank is the ability to basically borrow or lend. And so what they decided to do, instead of build the entire stack of a bank, is just build the most basic functionality of a bank and let other people build bank interfaces on top of the underlying interest rate protocol. So basically just the ability to generate interest rates. And that's essentially became our focus. So many things happened in this journey over the next couple of years that it's hard to condense, but it was an incredible ride. Like, I would say what it felt like was a ton of hard work, but every 3 to 6 months, we would achieve some sort of milestone. And we had a lot of focus during these sort of 3 to 6 month periods towards the next milestone. So what I mean is we would kind of sit for a couple weeks a month doing R&D, deciding what we're going to build over the next 3 to 6 months, then just 3 to 6 months of execution. And then we would launch like the first version of Compound and then the second version of Compound. And then, for example, like the proof of concept of governance and then the comp token. But all of these things, I think looking backwards, sometimes people don't realize that they were years in the making and they stacked over a very long period of time to eventually get to the outcome of Compound being a very large DeFi protocol. And for me personally, I learned an incredible amount about starting startups. I learned an incredible amount about crypto, about operating in crypto. My job as strategy lead in large part became about business development and growth and strategies around go to market. And it's not something I had ever done, but I think I was quite lucky. Like crypto was kind of the perfect industry for me, even though I never thought that I'd be in like a business development role before that.
Maybe some of those forks in the road for Compound that you mentioned that were years in the making, what were in your mind some of the key decisions, where it could have gone one way or another and you chose a road, and then, how did it turn out? So for example, now when we look at the industry, there's a fork in the road between, okay, we're going to lop off our connectivity to regulated financial institutions and the traditional economy and focus entirely on crypto native Web3 type stuff. And everything's algorithmic and collateralized by protocol tokens, versus the path of actually these DeFi machines are best used for the gigantic asset classes that everybody wants. So, how can we absorb treasuries on chain and pay the price of regulation, compliance, and so on? So like that's an example of a fork I think that's very relevant. I mean, now, but maybe 6 months ago. What were some of the things in your mind that stick out of that type?
It's a really fun question to think back about because in hindsight, because of the outcome, some of the decisions seem obvious, but they really weren't at the time. So some of the things I think about are in answering that question. One is from the very beginning, we were focused on institutions as the eventual target customer or target user of Compound. So a lot of my job was talking to these institutions. And when I say institutions, what I mean, at first, when we started, it was little crypto hedge funds that had $5 million, $10 million of AUM. And then it turned into large crypto hedge funds. As time passed, it turned into us talking to large crypto hedge funds who had $100 million plus of AUM. And then like fintechs and non-crypto hedge funds. And by the time I left Compound, after about almost 4 years, we were talking to, quite frankly, like the same banks that I worked with back at that financial consulting firm, like the largest banks that you can think of, about Compound and how they could use it and how it might fit into their products in the future. But from the very beginning, we were trying to talk to like the largest financial institutions in the world. And what it did was aim us in a certain direction where we knew that that's who we wanted the target customer to be. And also what we really tried to have is like a very institutional friendly brand and a very professional presence. And over the years, what happened is Compound, and especially Rob, I think became kind of a resource to really large financial firms and executives at that firms who wanted to keep track of and learn about DeFi. So that was one big decision. I think some teams now you see, especially if they're really focused on crypto, Twitter will be really focused on retail adoption. But from the very beginning, we were really focused on institutional adoption. Some other major, I think, decisions. One is the focus on being protocol first. There was always a little bit of a push and pull to understand like how much of the stack should we build on top of the Compound protocol while navigating business strategy as well as regulations. So we really quite early on, we decided that we were going to be protocol first, like try to be a neutral technology protocol on top of which we wanted hundreds or thousands of applications to exist that integrated Compound. So we had this very like integration first approach as well, which I think made a big difference later on. And yeah, a more tactical one is when MakerDAO and DAI started first taking off, I think in probably late 2018 or early 2019. We worked really hard to win over basically the MakerDAO community and sort of empower DAI within the Compound ecosystem. And that ended up driving a ton of early growth to Compound as well.
the wind up for the decisions and the outcomes, like you said, like is so cumulative. It happens over thousands of micro decisions that you take, but people don't see that. It's really hard to experience unless you've actually done it.
The defining characteristic of my time at Compound, from more of a general startup building perspective, is just focus. And I would have to credit Rob Leshner for this. We just had extreme focus on what we were trying to achieve. And at any given time, we were trying to achieve a fairly small number of things. I think it can get really hard at a small startup if you try to do too many things at once. And people say this all the time. You can look on Twitter and there's, startup gurus who are like, focus is the number one thing a young entrepreneur needs to learn. But putting that into practice, I think most people actually don't have any idea. You need to take it to an extreme. It needs to be more focused than you think is necessary or possible.
What are some tools to do that?
Tools to do that? Well, I don't know about tools, but I think it has to come from the executive team. One really interesting tool, and I hope this is a little bit of a personal story. I have the utmost respect for Rob Leshner, but this is one thing I always remember is quite early on. I would brainstorm with him a lot. I like to think I was kind of like the right-hand man on the business side for a lot of decisions and ideas. So the way that I work is like, I like to come out with as many ideas as possible and then edit it down. And he was a really harsh editor. So if I proposed an idea, the possible responses were either, okay, which means like, that might be a really good idea, or that's the worst idea I've ever heard. Don't mention that again.
Yeah.
And at first it was really off-putting. I was like, well, that's not very kind of friendly. And what I quickly realized is if you want to drive focus, what you need to do is tell people as quickly as possible what are the tracks they shouldn't go down. And that's all he was doing. He's saying like, end that track, go to a different track. And it's extremely effective if you know what you want to focus on. And he didn't say it in a mean way. He just said it in a very clear way. Like, we're not going to talk about that idea anymore. So that's one of the examples, I think. It's like, how do you tactically drive focus? And sometimes it can come off as harsh, but you really need to set the lines that you want people to stay within, basically.
Yeah, you've just described a generative adversarial neural network where, you're the idea generator and then there's the editorial filter. And it's super important to have somebody who's got good judgment, right? Because if the filter doesn't have the right intuition or doesn't have the right mental model or framework, then you're going to kill off all of these interesting creative directions. But, these are different skills too, like developing the right intuition and judgment and view is different from the ability to think broadly and be the idea generator and open up all these opportunities. So that's a great anecdote. I know that we're going through the conversation and we haven't yet talked about EigenLayer. So let's shift to that. What is EigenLayer? Let's start there. And then we'll talk about sort of your interest in it and what you're focused on.
So we call EigenLayer a restaking protocol for Ethereum. What that means is since the merge last year, where Ethereum moved to proof of stake, there's billions and billions of dollars of Ether that is staked to help secure the Ethereum network and help validate Ethereum transactions. This was obviously like a huge undertaking from the Ethereum community that was really successful. And the entire system is secured by this concept of proof of stake. At a very basic level, what it lets you do is have Ether holders stake capital, and that capital is insurance. So essentially that capital is validators validate Ethereum transactions. And if they do it incorrectly, their staked capital is slashed. So it lets you create this really simple incentive system where you incentivize people to do the correct behavior that you want, which is validate transactions correctly, or else they have this sort of insurance bond that is slashed. And that's their incentive to behave correctly. And that is proof of stake. What EigenLayer lets Ether stakers do, now that there are billions and billions of dollars of Ether that is staked, is restake that Ether so it can also be used to secure different and new networks and protocols. What does that sort of more practically mean? Today, if you want to start a new blockchain-based network or protocol, and you want to have some aspect of the same concept of proof of stake, which means you want in your system the ability to have users stake capital so that you can incentivize or disincentivize them to behave in a certain way. The way traditionally that different networks and protocols have done this is launch their own token, their own staking token, and launch their own validator network and have that be basically the security network that underlies their protocol. What EigenLayer lets those platforms and networks and protocols do is instead of launching their own token and trying to build their own validator network from scratch, they can rent it from Ether stakers. So at a really high level, EigenLayer is a marketplace between Ether stakers and validators and protocols and products that need stake and validation, where previously they would have to bootstrap all the stake and all the validation from scratch themselves, but now they can rent it from Ethereum.
I'm going to ask some naive questions because I feel like the elevator pitch is really clear and fantastic, which is like Ethereum has the best security, new protocols need security, they can now rent it from Ethereum somehow. But it's tricky to understand what's actually going on, right? So it's like you've got your staked ETH, and what does it mean to rent that capital to secure another network? Like, how does that work? Is it being rehypothecated? Is it getting plugged into another layer, another protocol? Like, can you talk a little bit more about that?
Yeah, so there's two different ways in which you can restake mechanically. One is if you are staked through an LST, a liquid stake token, through a platform like Lido or Rocketpool, you can deposit your LST directly into the EigenLayer contracts. And the EigenLayer contracts, therefore, kind of have some smart contract driven ownership of your assets. And then there are slashing contracts that can slash your LSTs. And that's the basis of proof of stake. Is basically you put your capital up for stake and you follow certain rules. If you don't follow the rules, your capital is slashed. The more complex mechanism is if you are natively staked to Ethereum. And so if you are staked directly to Ethereum, not through a platform like Lido or Rocketpool or a staking as a service provider, what you're able to do is set withdrawal credentials that tell Ethereum where you want to be able to withdraw your staked Ether. And what you do to use EigenLayer, to restake through EigenLayer, is you set your withdrawal credentials to the EigenLayer smart contracts. So EigenLayer will be able to trigger withdrawals of your funds and hold them in the EigenLayer contracts and slash them there if they need to. So what you're doing by renting is you opt in to these slashing conditions. You say, you can slash my capital if I don't follow the rules of the system, which are rules around validation or validating different protocols. And you as a staker, you can pick which products and protocols and networks that you actually want to validate for. So the whole system is opt-in. You could say, I only want to validate for new blockchain-based social networks, or I only want to validate for bridges. And then you can pick and choose which ones you actually want to restake your ETH into.
Could this potentially work not for ETH, but for, like the Matic token or for another staked protocol token?
Conceptually, it could, definitely.
There's nothing in particular about like the security guarantees of Ethereum, but rather it's the capital base of staked ETH that's being used for a secondary purpose.
Yeah, it's not. So there's really two aspects that make this really powerful on Ethereum, especially. One is the large amount of staked ETH, which is by far the largest proof of stake capital base. And also Ethereum has the largest validator set. So there's two basic use cases of things that can be built on top of EigenLayer. One category is things that want to utilize that want to have a lot of crypto economic security, which means they want a lot of staked capital. And Ethereum has the largest staked capital base. And then the second sort of category is based on wanting the most decentralized validator network. So you want as many validators participating in your network as possible. And Ethereum also has that.
Gotcha. But theoretically, you could like take the capital requirement assets of, some giant broker dealer, tokenize them, and also put them into EigenLayer as capital to be used in staking across various DeFi protocols.
Yeah, theoretically, actually, the architecture of the protocol as related to LSTs, the STETH and RETH, could accept arbitrary tokens. So yes, you could generalize it.
I'm obsessed with this idea that, the assets that are used to secure as capital requirements to secure the equity ratios of investment banks have some much more productive uses. And maybe that gets pulled into Web3 one day. How do you and the EigenLayer team see things moving forward? There's so much dynamic stuff going on, right? You've got unstaking as part of the upcoming upgrades. Like, what kind of dynamics do you expect in the staking market relative to EigenLayer? Like, do you expect catalysts from the Shanghai upgrade? Like, what's your emotional or strategic reaction to Lido and Rocketpool? Like, where do you think all that stuff's going?
It's fascinating. And as I've learned more and more about this market during my time at EigenLayer, I've come to understand it's a very complex market with a lot of players who are sort of optimizing for different things. You've got kind of a push-pull between decentralization maximalists who want validation to be as decentralized as possible and as accessible as possible. Like, the dream is that anybody, you, me, anybody can sort of solo stake from home and help validate the Ethereum network and participate in EigenLayer. That is a vision that we're really aligned with. We think that it's critical that validation networks are as decentralized and accessible as possible. I think that's sort of a driving philosophy of our founder and also of the company. And there's a push-pull there because there's sort of a natural incentive to centralize in some of these systems, especially in systems that are about like generating yield, whether it's through ETH staking or eventually EigenLayer restaking. There'll always be a push to sort of be the best, just sort of a natural outcome of capitalism. Like, there's going to be an aggregation of power where someone is going to be the best at staking or restaking, and they're naturally going to attract a lot of capital. So that's one of the most interesting dynamics that continues to play out. You can see it pretty clearly, in like the Rocketpool ethos. Or, there's lots of different platforms that are sort of focused on decentralization. I think that's something we're paying a lot of attention to. And it's something that we have to navigate because we want to build a protocol that gets a lot of adoption, but we want it to get a lot of adoption in a decentralized way, not just we can't just optimize for getting the most restake possible. We also want to have a lot of respect for decentralization and accessibility.
The other challenging question is, if you take a pessimistic view on why chains launch their networks, like, the pessimistic view isn't to create security in the best way, it's to create a speculative asset that generates returns for their holders and investors. So there's a tension. There's a tension of saying, like, we're not going to create our own token because we can get the security benefits, i.e. the chain works and there's consensus, through partnering with this different protocol. I guess, what is your response to that problem? And have you encountered it? What are some of the stories that people tell about these issues?
This is a really interesting topic. I think at kind of a macro level, it's a particularly good time for the idea of EigenLayer actually in this bear market, because people are less incentivized to just go launch their own tokens. And a lot of the builders that are in this space that have sort of survived this huge bubble and crash yet again, a lot of them, what they're committed to is not necessarily launching their own token and trying to capture as much value for their shareholders as possible, but in real technological advancement and the development of new business models. So I think it's hard to argue that from a protocol development and functionality perspective, that using EigenLayer, at least theoretically, won't be best for the protocol if you want to optimize for having a decentralized validator set and a lot of security. So builders that are focused on that, on building the best possible protocol, are still going to be interested in the EigenLayer. Now, there is a tension with the ability to kind of have a token and generate economic value that way. There's a mechanic in EigenLayer that we call dual quorum staking, where you could actually accept ETH restake and staking of your own token. So what EigenLayer would be good for in this case is you could launch your protocol or network accepting mostly ETH restake, and it'd be a great way to bootstrap your network instead of launching your own token, starting at zero from scratch. And then over time, as your network matured, you could actually move along a gradient to incentivizing more and more the staking of your own token, and you can transition some of that value into your own token. So that's one practical mechanic we have to try to solve that issue for people who are interested in basically doing both.
Gotcha. Yeah, I think a lot of development in the crypto space is about like, how do you remove the friction for other people to go fast or to bootstrap and create new companies and projects? And I guess there's a question of like, well, why do we want everybody to go fast? And the answer to that is because the whole industry learns really fast and you crunch through millennia of financial experiments in 6 months. And then everybody knows the answer to that and puts the counter to the problem into software to be reused by everybody else at a different time. But like, it sounds like this gives the ability for projects to bootstrap a validator set and then decide whether or not they want to do something else down the line, but like actually get over that initial hump and move much faster. And so it's like another arrow in the quiver of figuring out how to go from zero to 100 miles per hour, but even faster than was possible before.
Yep, exactly. And to launch a staking token and a validator network is extremely difficult. There's very little sort of infrastructure or best practices around doing so. Every project that has to do so does so in a pretty ad hoc way. If you want to build a validator network from scratch, you go talk to, every validator company one at a time. There's actually not a lot of infrastructure that connects projects that need staking and validation to stakers and validators. So we also want to be that.
Is there any systemic issue like where you have the same pool of capital, but there's some cascading series of like slashings across multiple networks that, because one network was attacked or something like that, then that starts to flow over to other networks that are secured by EigenLayer and then blows up ETH or something like that? Like, what are the systemic issues involved?
That is one of the big systemic risks, theoretically. And it's probably the issue on which we get the most kind of questioning and pushback is, especially after the events of the last year where a huge credit bubble in crypto popped that allegedly is based largely on fraud. People are very scared of leverage, or they think of the term rehypothecation as bad inherently. But I think that the concept of leverage isn't bad inherently. And there's leverage that is opaque and centralized and gate kept and not well understood. And that is bad leverage. Leverage that can be quantified, that is transparent, that can be tracked on chain and is sort of controlled by automated smart contracts. That's leverage that can be risk managed. And that's the type of system we want to build. It is a system where you'll be using your staked ETH and restaking it perhaps once and then twice, maybe 3 times, but there will be safe limits to the amount of times that you can do it, depending on which protocols you're participating in, depending on the rules of those protocols. And as long as we can build it to be as transparent as possible and as automated as possible, I think it will be possible to do it in a super well risk managed way.
Really fascinating issues. And I'm so excited to see it turn to fruition. I think it's going to have a huge impact. Calvin, thank you so much for joining us today. We've eaten up all the time with the conversation. If our listeners want to learn more about EigenLayer, as well as find you and all the different things that you're doing, where should they go?
Yeah, Twitter is the best place. It's at EigenLayer, EigenLayer. And I'm at CJLIU49 on Twitter. This year, there will be a bunch of series of launches of EigenLayer that I think and hope will be really exciting. So definitely keep an eye out.
Amazing. Thank you for joining us today.
Thanks for having me.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.